My name is Jake, welcome to the channel. In today's video, I want to talk about guidelines for dividend investing for long-term success. If you're a new investor, it can be incredibly intimidating and quite frankly stressful when it comes to investing into the stock market. There are a lot of uncertainties, there's a lot of volatility, and if you're a new investor, you might have a lot of questions. Well, what do I do in this situation? What do I do in this scenario? The market is at all-time highs. Is it safe for me to invest now? How can I get the best return on my investment with my strategy? There are so many different things that are in place, and the market is always changing. I like to think of it as a moving target. And the guidelines that I'm going to share today, I'm going to share 10 guidelines that I personally live by that help me gear the direction of my portfolio and my goals to ultimately reach financial independence. If you're new to the channel, that's what it's all about. My wife and I, we're in our mid-30s. We're looking to retire in our early 40s. We want to be financially independent from our 9-to-5 job, just from our dividend growth portfolios. So how do we do that? We're going to talk about that in this video. Before we dive into the video, I want to say thank you to all the new subscribers. We just hit 25,000. I can't believe it. This is so incredible to me. At my core, I'm an introvert. I'm not a flashy person. I'm kind of a to myself type person. I'm never the loudest person in the room. But with this YouTube channel, it's kind of helped me to get out of my shell a little bit. And, I've always had a passion for helping other people, inspiring other people. And I think this has been a great way for me to be able to do that and, to help other people. And that's really why I started the channel in the first place. When I first set up the channel here in 2019, I had no idea that it would continue to grow the way that it has. And I just want to say thank you to everybody. I read every single comment on my videos. And I just want to say thank you so much to everybody that has supported the channel. When I see a new subscriber or somebody commenting on the videos for the first time, because I recognize the name. So if you've been commenting on my videos, I recognize your name. When I see that there's somebody new on the channel that subscribed or is commenting for the first time, it kind of makes me feel like this.
High five! Meet me halfway! Come on, high five! High five! Yes! Ah! Nice.
When you think about other areas in our lives where we have guidelines or guardrails in place to help protect us, I think it should be no different when it comes to our investing lives. When we're investing into the stock market, it is so important that we understand what we're doing, or at least to the best of our ability, but we also have guardrails or guidelines in place to help steer us in the right direction. I kind of think of it as if you were to get into a car and you didn't have a GPS, a map, and you just started driving. Yeah, you're going to go from point A to point B, but you may not end up at the desired place. You're going to end up somewhere, but it may not be the place that you want to be. And when you think about it, in other areas of our lives, if you've ever been bowling, right? If you go bowling for the very first time, it's a little bit challenging. You look down there and you see, okay, the pins, that's the goal. I want to hit the pins. I want to get a strike. Now, that's the goal, but if you don't know what you're doing and you just throw the ball down at the pins, the ball may not actually hit the pins on your first try, or the second try, or the third try. When you first start out learning how to bowl, you have these little things on the side, they're called bumpers. And these bumpers prevent you from falling in the hole so that you are more likely, it's not a guarantee, but you're more likely to hit your goal and get a strike, to knock down all the pins. Now, if you don't have these bumpers or these guidelines in place, it's possible that you end up somewhere, you have an undesirable result or an outcome. And it could maybe kind of look a little like this. That hasn't happened to me directly, but I've had a very similar outcome like that guy that we just watched. So what is the first guideline that we're going to talk about when we're thinking about long-term success when investing in a dividend growth strategy? The very first thing when it comes to investing into a dividend growth strategy, the first guideline that we have to have is fully understanding our goal. What is our goal? Why are we investing? Are we investing for capital appreciation? Are we investing for cash flow? Are we investing everything? Do we understand what our desired outcome is? Remember what we talked about with the car from point A to point B? You're going to end up somewhere. If you invest anything into the stock market, let's say you just invest in the S&P 500, the NASDAQ, index, whatever, you're going to end up somewhere. But that's the first thing that you have to understand. And the reason why I mention this first is because it probably is the most important thing. I think investing into something that you don't understand is better than not investing at all, but it is so much more impactful and powerful when you know why you're investing. If you're investing in a dividend growth strategy so that the dividend can compound year over year, so that once you reach retirement, you can then live off of the portfolio. Or let's say, for example, you want to invest everything into growth ETFs or into Microsoft and Apple, hoping that they 10x, they grow exponentially, and then once you reach retirement, you're going to sell out of those and then rebalance into other assets. There's so many different paths. There's so many different things that you can do, but the most important thing is understand your goal. Understand your goal and then go for it. The second guideline is controlling your emotions. Now, this really entails a lot, but at the surface, when you think about our emotions, we as human beings, we are very emotional. When we're emotional based off of, music, what we see, like our different senses, right? If we see something or we hear something, it impacts the emotions within us. And so when it comes to investing, especially if you're working a 9-to-5 job and the money that you're investing is from your blood, sweat, and tears, right? You equate your dollars into time, hours, and when you see that go up and down, it can act as an adrenaline, but also as a depressant, right? Like it can be very depressing when you see the value of your portfolio go down. So that's the second guideline here is do everything that you can to control your emotions. Some things that I do personally is I dollar cost average into my portfolio. I get asked all the time, Jake, I would love to invest in the stock market, but I can't because it's at all-time highs. Okay, I can understand that. When I look at the prices of some of these ETFs or individual stocks, it kind of, gets me a little bit uneasy. But what I try to focus on is I have no idea and no one else around me truly knows what the stock market is going to do. So what I try to focus on is what I can control. I focus on cutting my expenses, staying out of consumer debt, and trying to make as much money as I can. And so by doing that, I then can control how much I'm investing on a weekly and monthly basis. So I dollar cost average into my portfolio. That is how I can control my emotions. If the stock market is all-time highs, so what? I don't care. I invest a little bit more. And then let's say the market goes down. Okay, great. That same company that I bought yesterday, I'm getting to buy at a cheaper price. So I average into the market every single week. And so if the market goes up, whatever. If the market goes down, okay, great. I know my goal, my long-term investing time horizon, I know my goal and I'm investing over time. And another thing, by controlling your emotions, what's really important is to avoid FOMO, the fear of missing out. You see everybody else out there talking about how much they made on Bitcoin or on Tesla or on GameStop, right? Like these meme stonks, right? All of that fear of missing out has saved me tremendously these last couple of years. When I first was learning to invest, I was really hyped up on these, on penny stocks. I thought, okay, I'm going to invest into it. It's really, really low. It's going to double and I'm going to be rich overnight. Unfortunately, it didn't work out for me. And it does work out for other people. Some people get really, really lucky, and I do call it luck. It can be maybe calculated luck, but at the end of the day, it is luck. If they're doubling their money overnight, that's what I'm saying. So those are the things that I focus on to control my emotions. I dollar cost average into my portfolio, and I avoid FOMO. The third guideline is really there's many paths that lead to success. You're going to hear a lot of people say, hey, if you want to get rich, you have to invest in this and only in this. Or no, hey, you don't listen to that person. If you want to get rich, you need to do what I say and do this. I tend to hear this and see this a lot on different blogs, on different videos and articles where there's the person sharing their opinion is saying, hey, if you want to get rich, you have to do it this way. And it can work, but what I live by is I understand that there's many paths that lead to success. Whether you want to go pure growth or you want to focus on value, that whole dilemma, value versus growth. I think a lot of people get stuck in the mindset of an all or nothing. It's all growth or it's all value, right? I believe that there's many paths that lead to success, and it doesn't have to be a one size fits all. And so when it comes to my guideline, I understand and I acknowledge that the way that I'm investing is not the only way to success. There's probably other areas out there that I could learn from, or other people or other investing strategies that I could learn from, and being, I guess you could say, humble and understanding that you don't know everything and being open to learning from other people and learning new strategies, because there's many paths that lead to success. The fourth guideline that I live by is when to sell a stock. I absolutely love Sure Dividend, suredividend.com. There's no affiliation, but I think they are great when it comes to their investing research on dividend investing. And what I like is their philosophy on when to sell a stock. And they have 8 guidelines or 8 rules of dividend investing, but there's one in particular that I really, really like. It's called the survival of the fittest rule. And what it is when a company that you invested in changes, let's say the competitive landscape changes, they're no longer, paying a dividend, they cut their dividend, or they're no longer a market leader. And so the facts have changed. And so we need to remain agile and nimble as dividend investors. And as things change, we need to be able to react to the things that are changing. You're going to hear me talk a lot about having, the stock market is a moving target, because that's true. Things are always changing, right? And so I love this. When the facts change, I change my mind. So if a company were to cut its dividend, it would then cause me to pause and think about whether or not I want to have the company in my portfolio. And so when the facts change, it's okay to change your mind and reassess what you have in your portfolio and whether or not it makes sense to keep the individual company in your portfolio if the facts change. The fifth guideline is around diversification, but most particularly around sector or industry diversification. When I'm constructing my portfolio and I have individual companies in my portfolio, I don't want to be overweighted or have a larger stake in an individual industry larger than 20%. I like to diversify among different industries, and no one industry will make up more than 20% of my overall portfolio allocation. The sixth guideline is around individual stocks and how much they should make in terms of your total allocation of your overall portfolio. I do not have one individual holding, one individual company make up more than 5% of my overall portfolio. So this is one aspect of it. The second aspect of it is the income diversification. Now we know that not all companies pay the same amount in their dividend, right? So for example, if you were investing into Verizon or AT&T, you're going to, and you look at the dollars that you're invested, you say you have $10,000 invested, you're going to get more income from AT&T and Verizon than you would, for example, with Apple, or for example, with Waste Management. So in addition to the individual diversification, individual holdings, I also want income diversification. I don't want one company making up more than 5% of my total overall income or cash flow that I'm getting from the portfolio. I call this diversification, but it is also, I like to view it as risk management. The seventh guideline is avoid the yield trap. The yield trap gets more new investors than anything else, I believe. When you're first learning about dividend investing, you say, okay, I'm going to go look at a stock screener, an individual screener, or an ETF screener, and I'm going to pick the ETF or the company with the highest dividend. That's what we call the yield trap. If a company is paying a high dividend, it's probably for a reason. It's possible that they're just about to cut their dividend. It means that they're paying more out in their dividend than they're bringing in revenue. And so this is a very, very risky play when it comes to dividend investing. So avoiding the yield trap is my seventh guideline when it comes to long-term success for dividend investing. The eighth guideline is around understanding the business that you're invested in. You have to understand if you're invested into individual companies, individual stocks, you have to understand that you're invested in a business. And you need to know, at least at a high level, you don't have to be an expert, but you have to know at a high level, how does the business that you're invested in, how do they generate their revenue? This is important because when you see the market fluctuate, when you see the stock price go down, you need to have the confidence that you understand that this company is still generating revenue, they're still profitable, and that you can then double down and buy more when the stock price goes down, instead of getting emotional and then selling the company at a loss when the share price goes down. The ninth guideline is around, does the company that you're invested in, if you invest into individual stocks, does this company have an economic moat? Are they shielded from outside competitors? If you understand the competitive landscape, if you're invested into a business, how sustainable is it? Do they have an economic moat? Is that economic moat wide or is it narrow? If it's a wide moat, that means there's insulation. They're protected against external entrants, external companies that are trying to enter their market and steal market share away from them. The 10th guideline is around tax efficiency. Optimizing your tax efficiency is an absolute must for long-term success when investing in a dividend growth strategy. When it comes to this, there's a couple things that you have to keep in mind. You have to keep in mind qualified versus non-qualified. So if you're here in the United States or international, understanding your country's laws around how the dividends are taxed in your country. So that's the first thing. Understanding qualified versus non-qualified, especially here if you're in the United States. The second is understanding the different types of investment accounts. There's a taxable account and there's a tax sheltered account. That could be, for example, a 401k, a Roth 401k, an IRA, for example. But understanding this and optimizing your portfolio for tax efficiency is an absolute must for long-term success when it comes to dividend investing. The stock market is very volatile. If you're a new investor, you have to understand that there's going to be market volatility if you're invested in the stock market. The 10 guidelines that I shared in this video are the guidelines that I live by. They may be different from your guidelines. The important thing is that you have guidelines to help steer you in the right direction for when the storm comes. Because there will be storms today, there'll be storms in the future, but you'll be ready. Thank you so much, everybody, for watching, and I'll catch you in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.